Coming up today, stocks continue to bounce back. Is this a bull trap? And could we roll over again next week? What's the bond market telling us? Along with commodities, I get you prepped for a big week ahead. And a US military base has just been attacked in the Middle East. You're gonna like this one, guys. Let's go. And welcome back to the Church of Optimism here at Click Capital. Thanks very much for tuning in with me today. I'm going to put the week that was in financial markets in perspective for you, present all the price action, trends and data, and let you be the judge of what's going on out there. Obviously started the week on quite a wild note. Monday morning, huge gap down, maximum fear. Saw the VIX shoot up to 65 on Monday, and we've pretty much bounced all the way back, almost making it to Friday's close, which was a pretty sharp down day as well. You can see that in market color. Green across the board up the front, except for volatility. Fallen again today. And doesn't this look appealing to short right here? Or at least buy some hedges. Very tempting. Looks like the market could just easily roll over again, as we may be making a bit of a low volume bearish pullback. However, I'm seeing that consensus all across social media and mainstream media as well, and it really reminds me of April and May in 2020. And I'm sure a lot of you guys watching this will remember that period vividly in your mind. COVID pandemic. Markets just sold off so sharply, so quickly. S&P took a 35% dive in pretty much a month. But we also saw historic and record Fed liquidity injection along with chopping rates. And something I'll never forget is that bounce coming out of there. In April, we were bouncing up and it looked so appealing to short. In fact, I even got some non-finance friends calling me, asking if they should short the market because the fundamentals were just so clearly bad. Global economy was shutting down. We're all locked at home. Business is coming to a grinding halt. However, Fed liquidity, along with federal stimulus, flooded the markets, and we just kept grinding higher, and there were so many people shorting here. I even remember Joe Kernan from CNBC saying around this time, anyone who buys the market needs to go and have their head checked. But we just kept grinding higher. A lot of people were shorting. And remember, we made a top coming into COVID around 3,400 on the S&P 500. And I remember the narrative was, surely we're not going to break out to new highs. That's impossible. And then we got this big down day here and people thought, oh, there we go. There it is. Time to roll over. Time to get short. Did have a little bit of volatility. Then it just kept drifting higher. And then look at that. In the midst of COVID, stock market made brand new all-time highs. Kept grinding. Got a bit of seasonal weakness there in September and October. Went back onto March higher. Santa Claus rally. And the rest is history. 2021 continued to rip up right until the end. Then we started getting a bit of volatility. The market figured out inflation wasn't transitory, as Jay Powell had been telling us. He had to start hiking rates, and that changed the structure of the market, like we can see technically here on the charts. And so 2022 was a bit of a bear market, in which we eventually found a bottom, and I'll never forget this day, the 13th of October. Massive bullish engulfing candle, 3,500 on the S&P 500, and then as you all know, we've ripped up since then. So here we are now. It's looking quite tempting to short or add a hedge, doesn't it? However, what you want to do in technical analysis is analyze price action on multiple time frames to kind of give you the full picture. And then, like as I do every day on the show for you, form some intermarket analysis. Looking at all key markets out there, trying to get even a more broader picture for where we're at. So if I just go out to a weekly chart on the S&P 500, this is the cash index, just represents regular trading. Can see some similar patterns in the past where we get a pullback, a few red weekly candles, then we get a big green weekly extension candle. We saw that in October last year. A little so in April, and that could potentially be the case again here. And if I just switch over to the E-mini futures, and futures kind of give you a more broader look at the price action as well, because unlike the cash index and stocks that we chart, you're just looking at the regular trading session in New York that runs from 9:30 a.m. to 4 p.m. New York time, whereas the futures pretty much trade around the clock, Sunday night, Friday night. And so just looking at the E-mini futures, we just put in a monster candle formation. Same deal on the NASDAQ, almost bouncing off that lows from April. Small caps, a bit of a hammer as well. And just looking at international equity markets, there's Hong Kong stocks. Japanese, Nikkei 225 put in a huge candle after their Black Monday. And there's the Euro stocks as well. Risk-sensitive Bitcoin also putting in a hammer candle. And look at VIX futures. Could be one of the biggest shooting stars we ever see out there, quickly rejecting off that huge levels. And we can see that in the VIX cash index as well. That massive abnormal print we got on Monday broke a lot of records, the amount of fear we saw in a bull market, and what a sharp unwinding we got in the yen carry trade. Again, just staying on the weekly chart, looking at the really risk sensitive Aussie dollar towards the Japanese yen, which has a big interest rate differential. Massive hammer formation on the weekly chart here on volume. High yield bonds appear to have found their footing as well. Actually closed higher than last week's close. However, don't get me wrong, I'm not saying we can't go lower. As you all know, I'd say if the market doesn't go below 5,000 for the rest of the year, that's kind of the best case scenario, considering we've only done about a 9.5% drawdown from yearly highs to where we got on Monday morning. If we didn't see the S&P trade below 5,100 for the rest of the year, that would be the very best case scenario, especially given the macro backdrop. Worries of recession, a potential large-scale war in the Middle East, upcoming US presidential election, which has already seen a number of ups and downs in the build up to that. We did get really overheated here coming into July, especially on mega cap tech. However, the economy is holding up, corporate profits are holding up, and that's why I think even if we do get down to 4,800 or 4,700, it's about a 17% pullback. And unless we don't have any new external surprise shocks, I'd expect the market to find support there. However, given this peak pessimism, I think it'd blow a lot of people away if we ended up doing something like this and we're at new all-time highs before the election. I'd almost call that the max pain trade. But just looking at market internals, we're still holding up okay. There's volume breadth. 58% of all stocks above their 50-day average. We have had a bit of a fall off and stocks making new 52-week lows. We're not all there on market breadth. And it was a pretty quiet finish to the week given how we started. And look at that. The VIX index already back to a 20 handle just after we came off 65 on Monday morning. And so I actually have to switch this to a logarithmic chart to have a proper look at it. Like I've been saying, I may find support around here, maybe down to 18. And I'd say given the macro backdrop, the VIX below 18 and definitely below 16 over the next few weeks. If we do get there, very well could. When the VIX crushes, it can do so quite sharply. That could be a good buy the dip on some insurance or hedges going into the election, because we normally see a rise in the VIX going into the election. But like I said on Monday, I'm 80% sure we've seen the high in the VIX for the year. It would just be very surprising to see it below 15 again before the election on the 5th of November, which is a bit over 2.5 months away. Also, a big dive in the volatility of volatility. Kind of think of this as the price of option. Like I'd been saying earlier in the week, if you're into selling options, that was a great time to do it. Elevated premiums, juicy puts, and then a potentially positive sign, we've got volatility risk premium. That's the difference between the VIX index, implied volatilities versus realized volatility in the market. Now back down to break even, and when you see a sharp crush in this spread, that can often be a bullish signal for the market. We saw that back in April, big volatility risk premium crush, and that helped to mark a low in the S&P this year as well. So option dealers are quickly calming down. Also got implied correlations pulling back as well. Bond yields have definitely stabilized. Good to see the 10-year holding ground above that support zone. High yield bonds back above their 50-day VWAP, and something I've just added to my watch list to be more visible on a daily basis, high yield spreads. Difference between high yield bonds and treasuries. Good indicator of risk in the market. That shot up as well to start the week. However, it's also done a bit of a U-turn heading into the weekend. And so that's pretty good price action across the board, especially heading into the weekend where there's a liquidity risk. We can see events, especially like in the Middle East, that market participants can't immediately respond to. So I guess it's a good sign to see a bit of risk on going into the weekend. But stick with me in this video, because that could be spilling over a little bit in the Middle East. We're just getting reports that a US military base has just been attacked, and I'll show you what's going on with that later, along with the reaction out of the commodity markets, which are still trading as I speak. So just to put the week in perspective again, we started on maximum fear and volatility, and we kind of just spent the rest of the week cooling down a bit. Got the weekly jobless claim yesterday, which is normally a non-event. However, that was more important this week as the market is worried about how much the jobs market is softening and is the unemployment rate going to accelerate. So jobless claims came in a bit better than expected, gave the market another sign of relief. And so I guess all those pundits, large financial influencers, must have spooked out millions of investors, caused them to sell on Monday morning. Didn't really get a crash. The sky didn't fall, nor did the Fed have to come out and do an emergency interest rate cut like a lot of people were calling for on Monday. Even some long-time respected economists get caught up in the heat of the moment. Wharton Professor Jeremy Siegel came out screaming on Monday, said the Fed needs to make an emergency rate cut at least 50 basis points, but he recommended they do 75 basis points. However, a few days later, he cooled down just like the market and says, oops, the Fed doesn't need to do an emergency rate cut after all. And wouldn't you know it, but Fed fund futures are starting to agree with my analysis as well. Like I've been saying for about 3 months now, including on Monday, I've continued to hold the view that the Fed will cut 25 basis points when they meet up on the 18th next month, and not 50 basis points like the market was giving pretty much 100% probability of happening to start the week. Like I said, this Fed fund futures can get quite volatile and a bit overexcited just like a lot of the market. And I'd say that pricing could firm even further come Wednesday morning. We've got an important week next week for economic data. We're going to get PPIs out on Tuesday, Consumer Price Index, CPI inflation data to start Wednesday morning, then Thursday retail sales, and at this stage just looking at the price action in the bond market and the latest print from Trueflation, which looks at a lot of prices in the economy, showing their year-over-year change at 1.41. My expectation is that inflation will come in at consensus, showing a 0.2% month-over-month increase, 2.9% year-over-year increase on the headline. Same deal for core inflation. And as long as it comes in as expected or lower, I'm quite confident the Fed will cut 25 basis points. We'd have to get a real surprise like this coming in at 0.4, year-over-year coming in at 3.2. Same with beats on core. For the Fed to possibly even stay on pause. And like I said, we can't rule out them wanting to wait after the election before they make their moves. Just see who they're dealing with in the White House and just really cover themselves for a possible resurgence in inflation, which just like a recession, we cannot rule out either. However, according to Fed member Barkin, he doesn't see a recession. He thinks the labor market is in better shape than feared. Thinks the Fed will start cutting in September. Said that jump in unemployment rate we got last week, just part of the normalization of the jobs market post-pandemic, and he attributed the increase in unemployment to higher participation rates and immigration. And he is optimistic about achieving their 2% inflation target. CEOs sharing a similar rhetoric to Barkin, just looking at a chart here. In the light purple, Q3 last year, dark purple, Q3 this year. Percentage of CEOs that responded last year, brief and shallow US recession with limited global spillover. And this is looking at the forecast for the next 12 to 18 months. 80% of them thought that was highly likely. A lot of us coming into last year were thinking that was the case. I changed my tune around Q3. Some of you will remember, just looking at the price action in the markets. Just didn't seem like a recession was imminent. Now 29% of them only see a brief and shallow recession in the next year. Only 1% of them see a deep US recession, and in fact now 70% of them do not anticipate a recession at all over the next 12 months. And that's because they're looking at their businesses. They understand their businesses better than the rest of us. They talk with all their partners and key customers on a regular basis. They've got a good idea of what's around the corner with their businesses and orders. And so based on all that, they don't see a contraction in the economy anytime soon. Of course, this can change quickly. However, for the here and now, the Fed's not seeing it. CEOs are not seeing it, and neither are a lot of economic indicators and high yield spreads over treasury bonds as well. Doesn't mean everything's perfect. There's never a perfect time to buy stocks. You can always find a reason to sell. But just keep in mind, again, if we get rate cuts and the economy holds up, that's actually bullish. There's an overwhelming narrative out there that as soon as the Fed starts cutting, that's bad, everything's going down the toilet, which can happen if the economy goes into a recession soon afterwards, which for sure can quite often happen. That's why the Fed is cutting rate. However, it could also be similar to the mid-90s. Inflation pulls back, jobs market can soften, but we go into that Goldilocks period where economic and corporate profit growth still accelerates and the stock market can enjoy a lower cost of capital, and we can actually get a good rally if we don't get a recession. And so it's just an amazing start to the week as we generated a bear market low level of fear in the middle of a bull market. That spike in the VIX was truly something else. And of course, that's just based on really loose pricing in the heat of the moment. Bid-ask spreads on S&P 500 options just blow out. Market makers drastically widen their bid-ask spreads. However, that's just an indication of the fear out there as well. Just creates so much dislocation, so much mispricing, and that's why it's good to use limit orders. Even when you're long-term investing, you can catch some of those crazy spikes. Just like back in 1987, the Black Monday back then, started out of Tokyo, just like it did this week. At one point on Monday, Nikkei futures were down 15%. Just looking back in history, when the Nikkei index has a one-day decline of 7.9% or more, what does it look like going forward? Well, in fact, we've only had 6 instances of that. Over the last 55 years or so, pretty much every single time, it was a buy-the-dip opportunity. And there's the daily chart on Nikkei futures. Found support from those October lows last year. Pretty sharp bounce, but we're just coiled up going into the weekend. And again, just looks like we're about to roll over again, doesn't it? And we very well could come down and test the midpoint of this candle, just like in the S&P. Who knows? May even come down and test the lows. But again, just look at that weekly candle. Looks like the mother of all hammer formation. And so potential retests on low volume, if we get signs of support and risk on markets, they can often make really good dip buy opportunity. You get that really soft second leg of a double bottom, create that bullish divergence in the indicators. And I'm sure if we trade back down here next week, that's going to invite a lot more bears to jump on board that as well. However, as I keep telling my viewers, there's no such thing as a long-term successful perma-bear. The best in the business have pretty much been washed out, because when you're a perma-bear, like unfortunately so many people are, I think a lot of them don't even realize they're perma-bears. They just get caught up in all the fear bait, all the crap being pushed by some of the largest channels who, in my opinion, are morally bankrupt. Sure, they get 1 million views on their video, they're making lots of money, but again, in my opinion, they don't really care about their viewers' wealth, because when they're convincing you to become a perma-bear, this is the chart that you're short. The most powerful trend in financial markets. Stocks go up in price over time. People naturally think because they've gone up so far, they must come down. However, I'd recommend to those people to study what retained earnings is and how a company doesn't even have to grow its profits to increase its book value over time. Not to mention inflation and population growth, among other structural tailwinds for why stocks go up over time. However, I guess as a perma bull, we shouldn't be too upset. Otherwise, we wouldn't be able to buy the dip on Monday morning at those extreme fear levels. And so again, there's a large consensus out there that we're currently in a bull trap. I had quite a few interesting comments on my video yesterday. Had a few people said they were looking forward to coming back to my video and laughing at me when the market turned back down today. And just to let you guys know, I'm not trying to predict what the market's going to do tomorrow. Nobody can do that with any accuracy. I'm just presenting the data and sharing my opinion. So we very well could pull back next week. No doubt I'll have a few people saying, "See, I told you, Jared. Told you we're going lower." However, just because we pull back for a few days doesn't mean the overall structure of the economy and market has changed. I would still just put the odds at greater than 50% that we've seen the worst of the yen carry trade, just like we've seen the worst in the volatility spike. And who knows? Nobody can see the future. We could get some large external shock event taking the VIX higher, along with the yen. But if we get that financial emergency, like many people are convinced we're always on the cusp of, then Big Papa Bear, Jay Powell's going to step in and open the window and get underneath market, especially going into a federal election. A lot of people convinced the AI boom is done as well. Been in a secular bull market for 15 years, but people say now it's done. VIX spiked, the yen, Nvidia, a small business in my local town shut down. Fact is, we're still seeing probably the largest ramp up in corporate capex that we've ever seen in history, spending on AI. Nvidia still has a long runway ahead of itself, still head and shoulders above the competition. And yes, tech stocks have gone up a lot. They are stretched. Valuations are questionable. However, what's also gone up a lot are their profits, and that's the big difference between now and the late 90s. They're actually printing money. Unlike back then, most of the tech stocks were junk, were losing money, ridiculous valuations. This time they're cash machines, and technology and AI is just not going anywhere, and US technology companies pretty much dominate the world. And I don't see European or Asian companies overtaking them anytime soon either. And if it is like the late 90s, and we're going into a period similar to the early 2000s, or maybe we're going into a period similar to the mid-late 1970s, a resurgence in inflation, tech stocks could very well fall over and underperform for years. However, if you pay attention to all the things I show you every day in these videos, relative strength, outperforming sectors, market breadth, what the trends are, then we'll naturally shift our focus to what's working and buy whatever other market is going up, just like in the second half of the 1970s. Commodity stocks significantly outperformed, pretty similar geopolitical setup from then and now, along with inflation and the situation in the Middle East. Pretty similar to back then as well. Israel being attacked from its neighbors, US coming in to defend it. We just had news out that a US military base at an airport in northeastern Syria has reportedly been struck by several Iranian-backed drones within the last hour. Fire and smoke seen coming from the base. Now just keep in mind, in the heat of moment of news events, not everything can be 100% factually correct. However, this channel that I follow here is pretty careful with trying to report the facts. They're an open source military intelligence monitor. And so just looking at some of their latest posts over on X, they just posted 20 minutes ago as I speak, no US or coalition casualties at the base in northeastern Syria. So that's a good sign, because if Americans were killed, the US is pretty much forced to respond. However, it could be a little flare-up going on over there. We're also just getting reports something appears to be going on at the White House. 40 minutes ago as I speak, Secret Service and firefighters investigating a suspicious object. But the president is currently in Delaware. So I'll keep an eye on this over the weekend. May just be a little isolated local event. However, we could still be on the cusp of a large-scale attack from Iran towards Israel. And if they inflict major damage on Israel, as the West has already promised Iran, they will go on the offensive. And we've still got some commodity ETFs trading after hours as I speak. There's the oil fund, just up a little bit, 25 basis points. And gold, just a touch higher, but nothing too much to speak about there. I'm expecting, if we do see a big spillover in the Middle East, for gold to quickly spike to new all-time highs. And I continue to have long gold exposure in my portfolio as well. Moving over to Bitcoin, we've seen a lot of volatility in the cryptocurrency. Had a huge dip to start the week, 28%. More data showing institutional investors bought the dip just like they did in equities. Did start trading really well after we're getting news of Trump getting behind it, speaking about potentially making Bitcoin part of the US strategic reserve. However, we also got news the Biden administration started offloading a lot of their confiscated Bitcoin, as in my opinion, they probably don't want Bitcoin rallying going into the election, as that'll more favor Trump. Also got a little good news coming out of China with consumer prices picking up. That's not what we want to see in the States. However, China had been grappling with deflation for a little while, and so you don't want deflation. Optimal scenario, you just want a little bit of inflation, not too volatile. You just want prices going up 2% or so a year. So they got a better than expected 0.5% increase last month compared to a year ago, and their deflation may have stabilized and can get back to inflating. And just something interesting to share with you guys today. Some call this a chart crime. I call it chart art. That's the stock price of Disney overlaid on the Disney castle. Remarkable similarity, with a lot of people saying the stock is reasonably priced and cheap now. It's had a pretty good earnings a couple of days ago. Stock has been beat down a lot, 123 to 86 this year. Still got a number of other high growing stocks that have been beat down as well. Celsius Holdings, really popular beverage company, trading almost $100 in May. Here we are at $38. Same with the athleisure company Lululemon. Started the year at $516 and chopped more in half, $238. And like we can see on my fundamental indicators here, the revenue and cash flow is still growing. It's not often you see these high growth stocks trading less than my fair value indicator. Same with Celsius Holdings as well. The business is still growing. It's looking like it's under fair value. Just had a huge pullback in the stock price. And there's Disney. Not looking too bad in the fundamentals either. Valuations, earnings beats. I'd say a lot of long-term value investors could be buying the dip here on Disney. As even though the problems they've had the last couple of years, they still have the largest content catalog and some say the most powerful brand in the world, along with diversified businesses. So they'll still very well be around for many more years to come. And who knows, at $86, 157 billion market cap, we may look back in a few years and see that as being quite cheap. Okay, that's pretty much a wrap for the daily market review this week. Once again, what a wild week it was. Started Monday with maximum fear, maximum panic, third highest print we've ever seen on the VIX, Black Monday in Japan, yen carry trade, recession fears, Middle East war. It's all happening. And like I said, if Monday's low was the low for the rest of the year, that's the very best case scenario. Because an 8% pullback, given the global macro backdrop, again, very best case scenario. Wouldn't be surprised if we do see 5,000 before the election, but who knows? There's a lot of consensus out there. We're about to roll over again. Market could very well just do another gotcha. We'll just have to wait and see, especially with what print we get on inflation on Wednesday. And of course, the language we hear from Jay Powell coming out of Jackson Hole later this month. Because if he doesn't cut rates next month, then I'd say the stock market might throw a tantrum like the bond market, and we very well may come down to 4,800, 4,700 in a couple of days of elevated fear and panic. No doubt a lot of people buying a lot of put options once we get down there again as well. However, you know what I'll be doing? Buying that delicious dip. Thanks very much for tuning in with me, guys. Have a great weekend, and I'll see you Monday night. Cheers.